Okay, welcome back to another edition of the Morning Mailbag, where here I am, Coach T, to answer your questions from tackletrading.com. This one is from Zafar, where he says, I have a question about callers. The normal practice is to sell a longer OTM call whose credit's the same as the cost of buying a short-term ATM put. Why don't we have a longer-term ATM put at a higher cost than sell shorter-term OTM calls? A lot of letters in there, Zap, but keep reselling the calls when they expire, assuming the stock isn't moving to recoup the additional cost. If we exit the caller, put will have the same value, calls would have paid for it. Let's talk about that for a minute. The caller trade, for those of you who don't know what it is, it's where a trader takes the stock and then they sell a call option and then they buy a put option. Okay. So they're trying to control the risk of the stock, they're trying to generate a credit from the call, and then they're trying to control the downside with the put, the general risk graph of it. And there's usually not a lot of profit in it, but there's enough to get people attracted and interested in it. It's a safety trade kind of thing. Let's take a stock LUV, which was recently in Gino's picks from the scouting report, which is available to pro members. And let's simulate. Actually, I already do have 100 shares of long stock. A long stock here in the risk graph. Use a lot of risk graphs at Thinkorswim. And then we'll simulate buying a long-term. Let's go to June. That'd be 126 days out. At the money put option, we'll pay a midpoint price at $350. Now, if you just look at it like this, and I have this on the day step, we'll go back to expiration. What at expiration? That just looks like a call option. That's just a protective put option. If you then sell that short-term call against it, let's say the February 7-day call option at, I don't know, $43.50, slightly out of the money, again midpoint price, you're now creating a trade, and I think I'm down a little on that LUV stock, so I'm going to simulate as if I was buying it now so you guys can see. The last price was $43.30. We'll simulate it at $43.30 as if we were getting into it fresh. Well, here would be the trade, Zaf, and there's not a lot of money in there. It kind of looks like a calendar spread. There are a couple of concerns here, and that's number one is if the stock goes up too far. If the stock goes past 45 between now and 7 days when this option expires, you can roll the other call. Yeah, absolutely. You have to be able to manage that call option. If the stock drops below 42.50, we do start to lose money. Now, there's controlled risk everywhere. You know, one concern would be the buying power. You got to put $2,400 out there to control this position. But for traders who like covered calls, this is the idea. And what Zaf is talking about is after 7 days, you'll go to 14 days, and which will only be 7, and you sell that one as well, pick up another 95 or whatever it's worth time, and then 21 days. So you continue to just sell and sell and sell and sell and sell. I like it. It's an interesting idea. There's nothing wrong with it. It's the same idea as rolling and rolling and rolling and rolling, right, with any particular credit trade. The only real concern would come with the management of the short-term option. Within 7 days, and what I'm going to do is I'm going to set the slices to the chart. Actually, we'll go back to this. I'm going to set them to break even first on 7 days out, which would be the short-term call. Then set the slices to the chart. So over the next 7 days, Zaf, it would have to stay in the middle here for you to make money on that first call you sell, which, I mean, it very well could. And if it does drop down a little bit, you can always sell another one and recoup it and roll it again. If it comes up a little bit, you could roll it up and out. So if you're going to use a strategy like this, which ends up kind of breaking this top side down and creating a profit zone here, you have to manage the break-evens both up and down is what it really comes down to, and you have to do a good job rolling the contract and understanding it. It's not as simple as just letting it expire and letting it expire. You have to kind of watch the inherent extrinsic value. Now, could we maybe change that a little bit, and instead of selling 7 days right at the money, which is aggressive and has to be managed, maybe we'll sell 35 days. more traditional. And instead of 43.50, we'll do 44, which is a little bit further out. That's going to open your break-evens up all the way to 48. So if you want a more casual management, consider buying 6 months to a year of time on your put and always keeping the call you sold about a month out. That will improve your break-even points over the weeklies. General rule in credit trading and theta trading, whenever you deal with anything less than, say, 14 days, they can be sensitive. They're good trades. And if you know what you're doing and you do a good job, you can find opportunity there, but they have to be managed a little bit closer. So it just depends on style and design, and that's where your rules come in, and working with a mentor and working with a coach to help you individually develop that is a really, really good idea. All right, another edition of the Morning Mailbag where we answer your questions on Twitter and in the Clubhouse. We always give preference to those who have signed up in the Clubhouse. We like the activity over there. If you're a member of Tackle Trading, come and log in over here. Click on Clubhouse, come down and find us, and post a question. And see if that comes up. We have the newsletter coming out this week. We have a scouting report that should have been due out, and you guys should have already been able to read that and see that. If you're not a pro member, consider upgrading. We've done a lot of really, really interesting things. Every Tuesday at 7 p.m. East, we're doing a live coaches show broadcast where the 4 coaches get together and talk about market conditions, and a really cool edition of what we put out recently, the Tackle 25. The Tackle 25 is for those of you who want to do things like covered calls, and there's some interesting ones in here where Coach Matt went through and the 4 of us and helped him out and built this thing out. A lot of interesting picks in there, and they're not necessarily advised in terms of go buy this now. It's more of a way for you to find good candidates to help you identify good opportunities. Okay, we'll see you back here down the road. Get in the game.
Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.